You could say that worked for a while, but certainly not on a long-term basis. Gold going to 3,000 maybe. Maybe the tech stocks, the big seven, maybe losing a bit of traction and people wanting other places to put their money. That could happen. Gold is under-owned in institutional accounts across the U.S. It's under-owned by retail investors. There's been some move out of gold into crypto. That might come back. I don't see why gold would go down this year. Every factor that is influencing gold in the last 12 months is still at play. So I really do expect gold to have another pretty good year.
The precious metals market stands at a crucial juncture as gold prices continue progressing upward, drawing attention from investors and analysts alike. Canadian mining entrepreneur Ross Beaty, renowned founder of Pan American Silver, has emerged as a prominent voice in this discourse. His prediction of gold reaching $3,000 per ounce by the end of 2025 has sparked considerable interest, particularly given his assertion that this milestone could be achieved despite a robust U.S. dollar. This scenario challenges traditional market dynamics. Current market conditions support this bullish outlook, with gold trading at approximately $2,760 per ounce as of Wednesday. The metal's recent performance has been bolstered by several factors, including uncertainties surrounding U.S. tariff policies and anticipated Federal Reserve interest rate cuts in 2025. While strong equity markets have provided some resistance to gold's ascent, declining U.S. Treasury yields and occasional dollar weakness have helped maintain the precious metal's momentum. Ross Beaty's observations about countries increasing their gold reserves to reduce reliance on the U.S. dollar align with the broader trend seen since Russia's invasion of Ukraine. Following Russia's invasion of Ukraine, a significant shift in global reserve management has unfolded, with numerous nations moving to reduce their dependence on the U.S. dollar. Countries including China, India, Uzbekistan, Poland, and Turkey have substantially increased their gold reserves, signaling a broader trend toward diversification of national assets. Russia's response to Western sanctions, shifting toward the Chinese yuan and gold, highlights opportunities and limitations in seeking financial autonomy. While the yuan has increased dependence on Beijing, Russia's efforts to develop alternative gold trading methods have faced significant challenges, revealing the complexities of creating new financial systems outside traditional ones. Before we dive deeper into this video, please take a moment to subscribe to our channel, hit the bell icon to ensure you never miss any of our latest updates, and share this video with your friends, family, and anyone who could benefit from the information we're about to share.
The gold market is an odd one in the last few years, really ever since the Russian invasion of Ukraine, because for various reasons, but especially because certain countries wanted to get off the U.S. dollar as their functional reserve currency, central banks have been buying gold. And this is really unprecedented in my lifetime. In fact, in the 90s, most central banks were selling gold. The Bank of England sold out of its gold. Canada sold out of all of its gold. But of late, a lot of countries have wanted to reposition their holdings of reserve assets. And so, led by China, but by no means only China, China bought 700 tons of gold last year. You have to multiply 70 times 30, and that's an awful lot of gold. And then it wasn't just China, it was India, Uzbekistan, Poland, Turkey. You could just name a whole bunch of countries that bought gold as an alternative currency asset, which demonstrates gold's long-term abiding store of value. And a lot of retail investors in China and India and Vietnam bought more gold than they've ever bought before, as an offset to concerns that their own currencies were potentially going to decline. And that's exactly what they did. So you had all of these new buyers of very large amounts buying gold in an environment when the dollar was strong and it got stronger. Yields went up, not down. Of course, quantitative easing was ending and quantitative tightening was going to begin again. Inflation was reasonably high. It was coming down, but it was still pretty high. A whole bunch of factors that are typically very negative for gold. And that's why a lot of the smart money in New York and Toronto did not buy gold. You saw last year, new money into ETFs went down. Actually, more money was pulled out of the U.S. ETFs than was put in. So very bearish from the sort of classical investor side, and yet the gold price went bananas. It was the best year in gold in, I don't know, maybe my whole lifetime. As a proportion of what it started out, it went up 27%. So it was a really great year. And I'm not surprised at that. I was very broadly forecasting higher gold prices last year, but I didn't expect to do so well. So today, who cares what happened last year? What's going to happen this year, right? And Yogi Berra said it right. He said, the trouble with prediction is you have to deal with the future. So it's never simple. But I really have to say, to sum up my own views, I don't see why gold would go down this year. Every factor that is influencing gold in the last 12 months is still at play. So I really do expect gold to have another pretty good year. Because if you look at the gold index funds, this place you can sort of see where passive money goes in and comes out. The GDX, between February and October, gold went up 20%, the GDX went up 52%, and the GDXJ, which are the junior producers and larger or more liquid explorers, went up 58%. So it actually did work out in that period, and then a lot of that was given back in the last couple of months. So there has been some move, but by no means the move I would expect. In companies like Equinox Gold, which has grown from nothing, really. We started this company, 7 years ago, just with an idea. We were going to try to build a big gold company that would be really leveraged to higher gold prices. And certainly the gold's moved. Gold was $1,350 when I started Equinox, and it's $2,700 now. Pretty good. We went from having no assets of any significant kind, a couple of exploration projects. We've bought 2 companies, built 4 mines, acquired 5 or 6 maybe, and sold 2. I mean, it's been a very busy company. The last mine we built, Greenstone, is now our flagship mine. It's up and running. So in that environment, our stock price has gone up a little, but not a huge amount, and nothing like you'd expect in a normal gold market where there's lots and lots of money coming into the space in conjunction with higher gold prices. It's a very odd market.
Ross Beaty pointed out the market's unpredictability, but noted that as long as central banks keep buying gold due to a lack of trust in the US dollar, gold and silver will likely grow. He specifically highlighted silver as having strong potential for growth. The precious metals market has shown remarkable strength, with projections indicating gold could reach $3,290 per ounce in 2025. Silver, meanwhile, has demonstrated awe-inspiring performance, with prices potentially exceeding $43.50. This forecast follows silver's robust performance in 2024, when the spot price surged by 21.46%, climbing from $23.65 to $28.90 per ounce by year-end. This substantial growth can be attributed to strong industrial demand, persistent supply deficits, and increased investment interest spurred by economic uncertainty. What makes silver particularly intriguing is its unique market characteristics. Valued at approximately $30 billion annually, the silver market is notably smaller than those of copper and gold, making it more susceptible to price volatility. This sensitivity means that even minor fluctuations in supply or demand can trigger significant price movements. Let's get back to the video.
Back in, so there was a giant move in the gold equities I can go back many cycles, but let's just say in recent years, it was in 2009. It was a huge move up that lasted for like 3 years. There was another one in 2016. There was another one more recently, post-COVID, or during COVID actually, 2001, not post-COVID, during COVID. So we've seen some pretty dramatic moves where I'm talking 20% to 100% moves in most of the gold stocks. That's probably going to happen again in the near future, I'd say. And really, it's like I said, it's hard to really figure out what will be the catalyst for that, but it usually happens. Nobody really knows what's going to happen, but I just think if you look at what has happened to gold in the last 12 months, there's no reason why it's going to change. Gold's done so well for all the wrong reasons. It's supposed to go down. It went up with a stronger dollar. Well, today, the dollar weakened. Gold went up. So it almost doesn't matter. Yields go higher typically. Gold's inversely correlated to yields. That's the Treasury bills have got higher yield in the last couple of months, and gold's gone up. It's upside down. So it's a blurry forecast in specifics, but as long as central banks keep buying, which they will do, as long as they don't trust the U.S. dollar, which is what a lot of foreign banks are concerned about, you're going to have a happy story in the gold sector. And silver, by the way. Silver is also going to be very strong. Well, silver, of course, is connected to gold. They're both precious metals, but silver has an extra component. It's much more used in industrial demand. And there's a broad range. It's the most widely used of all metals. It's used because it's the best conductor of electricity and heat and has all manner of incredible physical characteristics. The biggest demand sector right now is in photovoltaic cells for renewable energy. And U.S. is... Another thing American investors don't quite understand is how actually less important the U.S. is today than it's ever been before in the commodity business. The driver of commodity demand of every single commodity across the board is China. I mean, it's 2 to 3 to 10 times the demand of certain metals, even copper and silver. The big demand is in China, so it doesn't really matter what the outlook in the U.S. is for the industrial production of this or that, or what the U.S. is doing with renewable energy. It's what China's doing. And right now, they're going gangbusters on developing solar production and renewable energy generally, which uses more copper, electric vehicles, which use more silver. So it's a pretty good outlook for silver, both on industrial demand and as a precious metal. It'll follow gold, but if gold does well well and the economy does well, silver actually will outperform gold. And that's what could happen in 2025. But I say all bets are cautious because I just think capacity for unintended consequences with what happens under a Trump administration is significant. And those unintended consequences can be good and they can be bad. And flip a coin.
The outlook for gold and silver remains strong, with central bank purchases and global economic uncertainty continuing to drive demand. Gold has proven resilient, defying traditional market correlations, while silver has shown significant growth, bolstered by industrial demand and supply deficits. Both metals are expected to see further price increases, with silver benefiting from its smaller, more volatile market. What do you think? Will gold and silver keep rising, or could we see a market correction ahead? Share your thoughts in the comments below. If you enjoy this video, be sure to like and subscribe for more insights into precious metals and market trends. Thanks for watching.